As I mentioned, I'm a SCORE mentor. Um, uh, SCORE is a national nonprofit that was started back in 1964, and it's grown to where now there's over 200 chapters and over 11,000 volunteers like myself. Besides sponsoring educational workshops like this, we counsel small businesses, and that's really what our forte is, so to speak. We offer free and confidential counseling, and so if you want to start a business, or if you have a business that you think should be running a little smoother, we're probably the ones you should call. And I can't tell if there are slides up or not, but there's a slide that has our email address, our website, and our phone number if you need counseling. So locally here in Canton, we have 32 counselors, and each of us has a very unique skill set, business skill set. We have people that have marketed businesses before, have helped finance businesses, helped with supply chain, human resources. So depending upon where your weakness is, we would pull in the correct mentors. So our office is currently located at the Stark State University in the Business and Entrepreneur Building in room 331. We don't necessarily need to meet there. We can meet you at a coffee shop. We can do it over email, over the phone, at kind of what works for you. So on the screen, you should see a QR code with that information if you need it. With that, I'm going to turn it over to Brian Adolph, who is our presenter today. Brian, it's all yours.
Good morning. So I understand that we're all here for different reasons today. And I am going to try. Okay. I do have a little bit of an echo.
Yeah, we're not hearing it. Do we have a poll question at this point? Brian, you're froze up a bit. Okay, there we go. So if you could all take a minute to answer this poll question, and we'll show you the results.
Can you still hear me?
Yes.
Oh, okay. My apologies. I seem to disappear there for a moment.
Yeah, it looks like you froze up actually. I think they should be seeing the poll question right now, right?
Okay. Yeah, no, that's one for later on, but we can go ahead and take that one and then come back on later. And I am still getting that echo, but
yeah, it's on you, just on your end.
Okay, we'll try and ignore it. Okay, so I want to say good morning. I understand that we're all here for different reasons today. My name is Brian Adolph. As a short introduction, I'm currently serving as the treasurer of Canton SCORE. I specialize in areas of cash flow management. In my daily life, I'm the proud father of a 4-year-old girl and a 7-year-old boy. So we're not going to spend the entire time talking about them, as I know that I could. So as current work roles, I own Transworld Business Advisors of Canton, and I'm banker with Citizens. In my spare time, my wife and I own a mixable wine business that we're actually doing together. In my past, I've owned a mid-sized vending company in Northeast Ohio and a marketing company in California. And I say all this just to let you know that I've seen my fair share of financial documents, and I hope that my varied experience will bring some additional insights and value to the webinar today. As far as the poll question that I did want to have up right now was really just to raise your hand and let me know if you're responsible for your company's financial management, or if you feel like you
Good.
have any responsibility for your company's financial management. And really, it doesn't need to be you know, an official poll, but it's more of a rhetorical question than anything else. Because I mean, it's about money, and what whatever has to do with finance, from petty cash to the billion-dollar offering of shares, unless you plan to pay yourself nothing or charge nothing for your products and services, and you have no assets, um, you're going to have finance in your organization. You're going to need the management. Um, so there's really no escape from finance and management of that. So asking if we need financial management is really like asking if we need water or air. Financial management is closely related to accounting. In most firms, both are the responsibility of the vice president or finance or the CFO. However, it's really everybody's responsibility because it's the lifeblood of the business itself. Um, I guess we can answer that poll right now if we wanted to.
Actually, everyone,
Still is up.
if you look in chat, you'll see that most of them have um, some responsibility.
Okay. So, welcome to the Financial Management Workshop. By taking this workshop, you're going to be taking an important first step in building a better financial future for your business. It's really the dashboard of the lifeblood of your business and making better financial decisions. What we're going to be covering today is trusted advisors that can help you, financial management and why it's important for a small business, how financial management practice and rules and tools work, financial management basics for the small business, basics of startup financing, basics of financing and growing a business, and basics of working capital, and basics of fixed assets. So we've got a lot to cover and kind of a short time. So obviously, there will be additional questions and reasons to speak with a SCORE mentor about some of the areas that we're kind of going to gloss over and can be gone over in a lot more detail than what we can in this webinar. So many decisions that you make in your business affect you financially. One rule of thumb that we can give to you is to have a strong circle of influence. This consists of your attorney, your banker, your CPA, obviously your SCORE mentor, and your risk manager, who is most likely your insurance agent, to make sure that you're protected and you protect your business and profits moving forward. Oftentimes, bankers will speak to the CF or your CPA to get a better understanding of how your business is operating financially. But what's important to really keep in mind, and what you want to share with these trusted advisors, is finance in your business is personal. Everybody's going to have a different dashboard and different goals of what they're trying to achieve and what they want to share. So even when we go through the financial documents, you still want to have a special kind of document or goal that you want to share with your CPA and with your financial advisors. In a small business, that may be, I just want to have enough money to go on to fund vacations, or to meet certain goals for my family. And maybe you just want to have the documentation of where you are in that process and how far you need to go to get there. And you need to share that with your financial advisors as well, because that's different than a business that's trying to scale and grow and have retained earnings. Your advisors need to know when and why you want to take out money from the business and what the overall and arching goal is, because that's, like I said, it's personal to every individual that's running the business, and those goals are going to be different, and that needs to be communicated separately and differently. Okay, next. So as far as quality financial management, it offers many benefits to you as a business owner. Financial management includes bookkeeping, projections, financial statements, and financing, which forms the foundation from reaching your goals through sound business decisions. Like I said, you kind of want to make sure that you treat your financial documents as a dashboard to make better decisions. it's more than just making sure that you have profit margins. The direction of your company and knowing when to make certain decisions rather than just kind of making sure that your profit margins are there so you can weather the storm, so to speak. Financial management is one of the main avenues of success in the way that you are making profit and helps you decide when you can afford to invest in your business and to grow it. So if your business growth requires financing and loans, then financial management provides the information to know how much you can afford in your business. So from personal experience, as I mentioned early in the slide, I owned a vending company. And one of the things which I realize now looking back that I could have done a little bit differently is leverage and grown through acquisitions. But I was so focused on only investing what I had and in the cash and investing in capital when I had the capital available, that I missed a lot of opportunities. So, kind of keeping in mind that, loans, although some people may look at it as a liability, it can also be a productive liability when it means that you can grow your business, through those tools, which we'll cover a little bit later on. But it also gives you the documentation needed for those loan applications. So if you'll find that life is a lot easier if you have documented processes, procedures, and statements. So when you do need to take advantage of those lending tools, that you're able to go in and say exactly why you need them and what the projections are, and that you can have the confidence to kind of back up those numbers and what you're requesting.
Hey, Brian. Hey, Brian, you do have a
Those are
question.
kind of some of the benefits of financial management.
Brian,
Yep.
you do have a question.
Sure.
It's from Layla. Is the financial advisor different from other circles of influence on the graphics?
Yeah. So there's a CPA is going to handle different advice as far as how you're going to handle your accountant. And you may even have a different bookkeeper that shares kind of the documentation on your business. A lot of times, a business owner and their accountant won't necessarily speak with their financial advisor, and there'll be a gap there, which is why it's important to make sure that you're communicating between your CFO, your bookkeeper, your accountant, and your financial advisor, because a lot of times your financial advisor is going to be helping you plan for the future, put money aside, making sure that your estate planning is done, and reminding you of those things. And your CFO is going to be just looking at, saving you money in the operations side, and your CPA is just going to be trying to save you as much money on taxes. And really, all of those things need to be coordinated, and there really should be some communication in the middle. So to answer your question, yes, there is a difference, and there's a different goal for each one. But that's why I mentioned in the very beginning that it's very personal when you want to take out funds for those family vacations and for buying that new car and for putting funding towards a new house and those life goals that your CFO isn't really necessarily going to be a part of or know of. Your bookkeeper is not really going to be a part of or know of. And your financial advisor a lot of times treats your largest asset of your business separately from your other finances when they're even trying to figure out estate planning, putting retirement funds and things aside. So that's why it's really important to kind of communicate when and why you want to take out funds and how you're treating your business, and make sure that everybody's on the same page. Does that answer that question? There's no one size fits all financial advisor that's going to cover your, or have the expertise to save you the most money in taxes to treat your bookkeeping and handle the margins on your business. There's different experts in the field, and you really do want somebody that's going to be protecting your business on the insurance side and looking at the operation side and also helping you plan for the future. But you also want to make sure that everybody kind of knows your own personal goals with the business at the same time.
I think
Which should bring
Layla's
us
saying
into
it's still,
the next screen, which is budgeting.
yeah. Hey, Brian, Layla says it's still a bit confusing for her, but she's just going to keep listening. So, so go ahead.
Okay. Yeah, so I guess financial advisors would help you plan for the future more on the personal side a lot of times. And your CPA is going to help plan for your taxes and how you're filing those taxes. And a bookkeeper is generally going to make sure that your documentations are being done for the business. As a business owner, you want to make sure that you tie all those things together. And if you're a small business owner right now, some of the slides that we're going to be going over today are going to help you make some of those decisions. Okay. Let's start with the budgeting. So as far as creating a budget, it's the first place that we start in financial management practicing. So a lot of people know what a budget is on the personal side. So it's a budget of a list of all your expenses that's organized by categories. It's a tool that helps you track all your expenses and plan for your future, economize when needed, and plan for expansion in order to make a profit. It's very similar to when you budget, for your family, but it's really good to keep in mind, however, that no company is going to shrink its way to growth, and a flexible budget can sometimes be necessary to not only roll with the punches in a small business and with their small business finances, but in order to prosper, you kind of need to be flexible as well. So with this in mind, you also want to look at your budget a little less rigidly. And kind of rather than simply looking at the numbers, you want to look at what those numbers mean and how they affect your business overall. So it's important to kind of look at the big picture of your business when you're looking at a budget. Again, because no business is going to kind of cut their way to growth. So to do this, you'll need to look at the lens of 4 different types of expenses, regardless of what category they may fall in by definition. And only you as the business owner can really determine this. So there are 4 different types of expenses to kind of look at things through the lens of. And those expenses are destructive, consumptive, protective, or productive. So regardless what category in your budget and line items may fall in, you need to ask yourself whether this expense for your business is destructive, consumptive, protective, or productive. And what I mean by that, so a destructive expense is something that's not helping your business to grow at all. It's something that's just taking up resources. And those are the ones that you want to cut. So if you can identify those items that can be cut from your business and keep your business on track, regardless what category that it falls into, those are the items that, yes, you can absolutely cut out because it makes your business more effective. So you always want to look for and identify the destructive expenses because they're hindering your business.
Hey, Brian.
Consumptive expenses are expenses that you need, obviously, and they're always going to.
Hey, Brian.
Yep.
Do we need to be on a different slide? We're on like slide 4 or something like that. Track the 4 types of expenses. Are they on a slide all by themselves?
No, this is
Okay.
this is part of budgeting.
Okay.
So when you're considering a budget, it's important to kind of look at, before you make the decision to cut these expenses and tracking these expenses. Of course, you want to track all your expenses and planning for the future. And this kind of falls in the category of tracking those expenses and planning for the future. You need to identify the expenses. And what I mean by identify them, you need to find out personally whether they are destructive for your business, whether they are simply consumptive and can be lessened, whether they're going to help protect your business in the future, so they're a necessity in case something goes wrong, or whether they're productive. So a productive expense maybe would be you are paying an employee maybe 4 times more than your competitors. However, you know that they're 4 times more valuable to the company because they help your business grow at that. So some other company, or maybe you're a financial advisor even, would take a look and say, you know, you should be paying them less, but you know that they're impacting your business in such a way that it's a productive expense. So you absolutely don't want to cut that. A productive expense is going to be your insurance coverage, that you know if something happens that, you know, it could really majorly impact your business. So you don't want to cut down on protective expenses that where something could go wrong, it could derail your business. Consumptive expenses may be lessened sometimes, but you never want to take them away because, again, they're expenses that you need for a business. Really, it's just the destructive expenses are the ones that you want to get rid of, because those, they don't really help your business in any way. So, like I said, these are more the personal questions in budgeting that you kind of want to ask yourself when looking at the total picture, when tracking all those expenses and planning for the future. And you kind of want to see how they fit in with those things. So and additionally, so just kind of drawing the parallel between a personal budget and a business budget. So just like somebody may have a pay yourself first 3-line budget in personal finance, a business can have a similar structure. So in personal finance, you may decide what percentage of income per month that you want to set aside for the future, and then what percentage you want to spend on charity and what percentage is reasonable for guilt-free rewards. In a business setup, you might want to have something similar where you just have 15% off the top of money set aside for a pay yourself first, you know, kind of like a wealth capture account for your business, just to cover unexpected expenses. And of that 15%, you can maybe have 3% that can be spent on consumptive expenses that are completely guilt-free spending for your business that can be used to help boost morale. So consumptive expenses can also be used just to help further morale and things like that. So they're not necessarily needed for your business, but it can also help your business in that way. So, I mean, that's a lot on kind of the budgeting from a not number standpoint, but it's really important to not necessarily always look at the numbers, but also how they impact your business overall. Not necessarily the line by line, but also when creating a budget, look at how the numbers can affect your business, not so you're, you know, kind of cutting yourself off the knees and not growing because you've tried to shrink your way to wealth and you're cutting off your productive assets. And we can move on to the bookkeeping. Bookkeeping involves the recording and the classifying of the financial transactions in your business. It's keeping track of what your business spends and what your business receives. These tasks are used to manage using the books and ledgers, and that's hence the name for bookkeeping. Originally, the transactions would be recorded in day books and cash books and journals, and then transferred to a ledger. So bookkeeping software really kind of takes care of all this nowadays. And even with today's online banking and business accounts, a lot of these features are included in the online banking features as well. And QuickBooks is known for this, and there's also free accounting software that also helps to keep track of bookkeeping. But always keep in mind, it's dependent on the amount of information that you're able to kind of put in those things, as far as categorically putting those labels on things in order to get that information that you can use out as far as knowing what the expenses were in the first place, so you can look back on them in the future. So next slide. So when it comes to bookkeeping, there are 2 terms that you may want to familiarize yourself with, and that's the cash basis versus the accrual basis. So very simply, a cash basis business recognizes income and expenses when they're paid or received, not when the product or service is actually delivered. So you think of invoices when you send out a product with the expectation that a client is going to immediately pay you. So if you're taking money for a job right up front, you would be on a cash basis. Think about a travel agent that gets paid for a travel expense, and they may be flush with cash for most of the year when they get paid on trips before the people actually take their trips. Or if somebody gets paid for a job a month ahead of time before it's actually done, and it's recorded in the books when they actually take the cash rather than when the job is done. The opposite of that would be the accrual basis, which recognizes the income and expenses when they're acquired rather than when they're received. So you can think about convenience stores when they have inventory, but they're not paid for that inventory until the product is actually sold. So if your business carries extensive inventory, the IRS is actually going to require you to be on an accrual base bookkeeping. Some of the key differentiators between accrual basis and cash basis is accrual basis is going to be when something is earned, and cash basis is when it's received. Expenses are recognized. So that's when revenue is recognized. Revenue is recognized when it's earned rather than when it's received. With the accrual basis, expenses are recognized when it's incurred. And on the cash basis, expenses are recognized when it's made. So really money out of your pocket and into your pocket on a cash basis, it's cash basis. Think about it just like cash, you're handling cash. Accrual basis, it's more invoices, accounts receivable, accounts payable, and thinking about, when something is actually going to be rendered. That being said, tax payable, it's on earned revenue on the accrual basis, and on cash basis, it's only when taxes or when cash is collected. So when you file your taxes at the end of the year on a cash basis, if you've collected money for a job on December 31st, it's going to be on that tax year. However, on an accrual basis, if you haven't collected money for the job yet, even if the job has been done on the accrual basis, that it won't report till the next year. So accrual-based accounting combines two accounting principles. It's the matching principle and the revenue recognition principle. The matching principle says that expenses should be recognized in the same period as the revenue that they actually generate. The revenue recognition principle states that the revenue should be recognized when it's earned and realized. So when a business performs the actions, that's when it's finally entitled to the revenue. Accrual accounting generally makes the relationship between the revenue and the expenses clear. It provides better insight into the actual profitability rather than just when cash is exchanging hands. Some examples, if an annual or multi-year contract memberships or subscriptions are paid in a single lump sum, the revenue or expenses is spread across multiple periods over the life of the contract of the subscription. Or for payroll, vacation, employee benefits, they accumulate between payroll cycles. The company recognizes each expense throughout the year during the period that it applies to. So these are some examples of accrual base. Or when utilities or rent is billed after a period in which they've been applied, and the company accrues the expense during the period that it's been used for the utilities and the rented property. Or for income tax and sales tax that it's due on revenue, the company recognizes the tax during the same period that it recognizes the revenue, even though that it pays the tax when it's required by the IRS. So interest on loans is recorded during the period that the principal is outstanding, even though it's paid at a later date. So when to use the accrual-based accounting, most investors, lenders, and financial institution will actually require from general accounting principles and financial statements when evaluating a business, which is a major reason that a lot of people will switch over to the accrual-based accounting as a more popular method. And the IRS will actually state the small business with less than 25 million in annual revenue to use the accrual or the cash-based accounting sole proprietors and partnerships and S corp, they're allowed to use the cash-based accounting. So if you carry a lot of inventory, you're going to have to use accrual-based accounting. And like I said, it's a more popular method as well, and just because it does more accurately reflect when profit is being made. So it's good to familiarize yourself with, and when you're small and you can kind of track things, cash in, cash out, then you can use the cash base to start off with, but you kind of want to go into the accrual based accounting later on. So thoughts on why to include that investors and lenders may require this method, even if they don't. The consistency in the metrics in the business look more stable when it's not showing the cash going out in large sums or cash coming in large sums on the cash base. So if your business relies entirely on cash payments, both for revenue and expenses, then accrual accounting may not be the right fit. But for other businesses that extend credit and customers are paying, so you have accounts receivable, you have inventory, then accrual accounting really does give a more accurate picture for the overall financial health of the business. So in general, the greater lag in payment time, the more that you have an argument to use accrual based rather than cash based accounting for a better picture of the business. Next.
Hey, Brian, you do
Yep.
have a few questions.
Sure.
One of them goes back to that destructive expenses. Emily was asking, can you give an example or two about regarding that?
Sure. Treating yourself to an expensive breakfast every morning and expensing it.
That's a good one.
It may not. It probably doesn't help the business. However, I have a Starbucks every morning, and I could argue that it helps me focus and be more productive. So it really is a matter of opinion.
Okay.
So if it does help you be more productive, you can make that argument. However, if you know that it's just a destructive expense, then you can obviously try and cut it out of the business. So anything that's clearly something that's not helping your business in any way, then and can be cut out would be a destructive expense.
There's some other questions regarding accrual versus cash.
Okay.
Whether it's a transfer to banks, Venmo, or other methods of payment, is it treated as cash or is it accrual? Even credit card payments, they're questioning what side of that ledger would those fall on?
Yeah. So how you accept payments doesn't necessarily mean how you record the payments. So if you have a net 30-day payment terms, or if you have, so let's say you accept payments 60 days out and you're paying for things 30 days out, those can construe your books if you're on a cash basis. It really doesn't matter how your customers are paying you or how you're paying for things. If you're on a cash basis and you have a long collection time for your receivables, or you have a longer period for payables, or you pay for inventory up front, that's where you get a less accurate picture of your business, and the cash flow concerns actually become more pronounced, especially in at the end of the year when maybe there's a you buy more inventory because they've been on sale and you're actually producing a product. That's going to throw off your books if you're on a cash basis, because the cash is going to be shown on the cash basis that you've spent that money. And it's obviously not going to be sold for some time because you're going to be holding on to that inventory. So it's less about how you're accepting the payments and more about how it's being reflected over time.
Can expenses be both accrual and cash, or does it have to be one or the other?
It'd be one or the other. You can't really mix throughout the year, and you want to stick with one or the other. You can switch from cash to accrual, obviously, and you'll want to do that and kind of move in that direction. But obviously, you don't want to go from one to the other because it can kind of confuse things, and it'd be difficult to kind of explain, especially when you look at tax returns and whatnot, the difference. But for consistency in your business, and again, we're using these financial statement to kind of plan and make better decisions. So if you can kind of look for the stability in the accrual basis and spread out payments over time, you want to have kind of that picture of when, what kind of the revenue is being generated throughout the year on a monthly basis, which would be the benefit, rather than on the cash basis where you just see kind of the larger payments coming in from time to time. So if you can kind of divide up. And another way of thinking about this is if you were to buy a pair of pants or jeans or something like that, and you were to look at a cash basis on how to depreciate that, you'd go ahead and spend the money for it, and you'd have the cash and the expense done right then. On the accrual basis, you would go ahead and divide out that expense throughout the rest of the year, say of $5 every month of the useful likelihood or lifetime of that product being used up. So because you're going to be using it throughout the year rather than just the one time.
Is there like a certain time when would you decide if you want to move a cash from cash to accrual? Sorry, we're kind of backing up here a little bit.
No, you're fine. So I would talk to your accountant and not change horses midstream. Would
So
be
kind of
probably the best way to look at it.
kind of decide on it kind of decide up front then.
Yeah, you want to plan for the year ahead.
So you could change it when you go into a new year.
Yeah.
Okay.
Yep. And you can always kind of look back and look at the difference, because you can always, if you were cash basis in the past, you can go ahead and see what that would look like on an accrual basis, because you have the cash basis documentation. So you can always use that as an exercise to see, okay, well, if I was to change this to an accrual basis, or if it was documented as accrual, does it make sense and does it help? Which may be a better barometer. Yeah. I'm not sure. Okay. So I think we're on financial statements. Yep. Okay, so it's important for business owners to become familiar with their company through the financial statements and how to use them in their business on a regular basis. So if financial reporting is done right, then you get that more complete picture of your company's finances in regard to the revenue, the expenses, and the profit. And of course, the cash flow, which is ultimately the lifeblood of the business. And as I've mentioned, the accounts receivable and payables, really in the space between those, is ultimately what's going to help stabilize a business. Far too many companies have gone out of business, not from lack of profit, but from lack of cash flow, where they've had really large orders from large corporations that those really long payment terms that they've been waiting on. And because they've had to spend so much money on the inventory or the cost of doing a job up front, and then they've had to wait too long on the back end, that they've unfortunately gone out of business. And in the meantime, the auto industry and parts suppliers are a good example of that. So what is financial reporting? Typically, when we talk about financial reporting, we talk about the three statements. It's the balance sheet, the income statement, and the cash flow statement. These three statements are actually interrelated. For instance, the balance sheet, it's a snapshot in time of everything that the company owns and owes. It's the equity. Then in between one balance sheet and a year and the next, we have what's happening. And this is the income statement, the cash flow statement, and that's what they describe. So more specifically, the income statement will show you what happened from one to the next in the balance sheets. And the cash flow statement, on the other hand, is going to tell you why the cash changed from one balance sheet to another. So therefore, those two statements are like the documentaries in time between the balance sheets. The income statements are the documents the equity changes, while the cash flow statements just documents the cash changes. So our poll question is, raise your hand if you know when you can take a draw from your business.
Gwen, we're not seeing the poll question.
I don't know if I can pull it up. Okay, yeah, that was the, okay.
So what's the poll question?
Yeah, so
Brian?
the poll question was, raise your hand if you know when you can take a draw from your business. And the question, the answers I believe were anytime, once per year, twice per year, whenever, only when there's money to do so. But
So what's the correct answer?
so the correct answer is, so companies should limit the draws so when there's enough cash to do so. However, they can really take a draw whenever. So while your employees get paid every time that you do payroll, you don't have to take an owner's draw in regular intervals. You can generally just take a draw whenever there's cash available to you. So a draw is neither payroll, it's not a dividend. A draw is just withdrawing from the profitability of the company, and that's really all it is. So you can take a draw whenever. So that being said, if you can set a minimal amount on a set schedule for your own kind of payroll purposes, and so to speak, there can be many benefits to do so when you talk to your accountant, more for kind of the stability. Also, on that note, there are also regulations if you're filed as or filing your taxes as a LLC, filing as an S corporation, and you're a partnership, you need to take equal draws. So a lot of people don't realize that if there's two partners in an organization, they have to pull their draws out at the same time in equal distributions. So that would be the answer to that. And really, it can be any time because it's just the profitability of the company. And it's if it's a subchapter S company, it just has to be equal distribution if there's multiple partners. If it's a multi-member LLC. Yep. And next. So the income statement, it tells you how much money a company has brought in, its revenues, how much money it's spent, and the difference between the two, so its profit. The income statement is the basic structure that generally starts with the revenue that the sales have made, and then it subtracts the cost of the goods sold or any cost directly related to sales themselves. So from there, that's where we end up with what's called the gross profit. Next, we'd subtract out the operating expenses and what is sometimes called the selling and general administrative expenses. Examples would be the wages, the marketing, the IT, which also includes the cost of depreciation. So from that, we get what's sometimes referred to as the operating profit, or EBIT, the earnings before interest and tax. Next, if we deduct the interest expense, we have the number of earnings before taxes. And if we deduct the taxes, then we end up with the net income. And that's the general structure of the income statements. It's important to note that profit, and it's in its simplest form, profit is always equal to the total revenues minus the total expenses. However, there are several commonly used profit subcategories that investors should be aware of. So there's gross profit, which is calculated as the revenues minus the cost of sales. And it basically just shows how much money is left over to pay after the operating expenses. And hopefully that'll provide the profit after all the sales are made. The operating profit is equal to the revenues minus the cost of sales and all the operating expenses. So that really shows after not only the cost of goods sold and pretty much all the subcategories, not only the payroll, but anything that goes into something. The number represents the profit a company made from its actual operations, which includes everything, and excludes certain expenses and revenues that may not be related to this, central operations. So there is a difference in gross profit and operating profit to kind of in the subcategories of profit to kind of keep in mind. It's also good to note when somebody has, when looking at an income statement, that the cost of goods sold can also be sometimes deceiving because labor can also be included in the cost of goods sold. Because on a service-based business, say like hospitality and restaurants, their salaries and wages are also going to be on a separate line for salaried employees. And then hourly employees is often included in labor because they are providing the service that's included in their cost of goods sold for providing that service. So sometimes you have the labor expense kind of not counted twice, but it's included in their cost of goods sold. And then salaries for salaried employees and managers is also under salaries and wages. And sometimes that gets overlooked. So
Hey,
on a side
Brian.
note,
Hey, Brian, what's
it's
the
really
biggest?
important to read from the income statement the company's profit margin, and you actually get this when you divide the bottom number from the top. So the net income generally represents the company's profit after all the expenses, including the financial expenses, have all been paid. And this is the number called the bottom line, and that's why it's on the bottom line of the income statement. And then when somebody refers to the bottom line of a business, it really means how much is left over after everything. A lot of companies can have a very high revenue, but the bottom line really says what's left over. So if a company makes $3 million and it costs them $3,010 to get that $3 million number, it's still in the hole.
Hey, Brian,
Mm-hmm.
what's the biggest difference between the cost of sales and the cost of goods?
Cost of sales and cost of goods are generally the same thing. So you'll hear them both ways. You'll see it both ways. It's the cost of producing that product or service and what goes into it. So in manufacturing, you're going to have cost of goods. In a lot of service business, you're going to see the cost of sales. Whatever it costs that company to produce that service or to produce that good is what's going to be in your COGS.
Thanks.
Mm-hmm. And next slide, the balance sheet.
Gwen, can you advance the slides? Thank you.
So on the balance sheet, a company's balance sheet is the financial snapshot of everything that company owns and owes. It's called a balance sheet because it always has to balance. So the difference between what a company owns and what it owes is called shareholders' equity. So also known as the net worth or the owner's equity. So this principle, it's really very similar to what people understand about a home equity. For instance, the home is an asset. So you own minus the mortgage, which is what you owe. So the true value that you hold or the equity in the home would be your home equity. So the shareholders' equity is very similar. So you own the asset of the business, and then what you owe on your mortgage versus what the asset is actually worth would be the equity. So the shareholders' equity would be very similar in a business. So now the more important thing about the equation before us is this: in every transaction and through every change in the financial reporting of the business, it always has to be equal on both sides. So the left side always has to equal the right side. So liabilities plus equity. Assets equal the tangible and intangible value of things. The liabilities are the responsibilities owed, and the equity is the difference between the two. So the equation always holds true as far as what the business has in its assets, and the equities and the asset minus the liabilities, it always equals the equity left over. So if you were to buy a sewing machine, for instance, if you had a sewing business and you bought a sewing machine for $100 and you bought textiles for $30 to make something, and then you made those things, and then you sold them for, let's say, $40, and then you had to adjust for the profit. I'm just trying to think of this off the top of my head. You would record then the profit. You no longer have the $30 in what you had for the textiles, but you still have the asset of the sewing machine, and then you have the profit of what you sold. So minus the liability that you had for the textile, because you no longer have that. So things would still balance out on both sides of the equation. So it's always going to balance out when you have money coming in, or when you have assets on hand versus your liabilities. So as your liabilities change, as you pay those off, and as you bring in profit to the company, your assets and liabilities are always going to be equal on a balance sheet. I think we have an example of a balance sheet on the next slide. So here's an example of a balance sheet. And as you can see, the left column is a total, and at the bottom, it should always match the right column. Okay, and then on the next slide, we have the income statement. So this is an example of what an income statement should look like. The income statement is one of the three major financial statements. It reports the company's financial performance over a specific period of time. This one shows you a comparison over the last few years. And then we can let's move on. Okay. The cash flow statement. Cash flow statement is often overlooked, but I think the most important of the three, to be honest with you. And that is because, like I said, the cash flow is really the lifeblood of any business. And you can always look at this and kind of make adjustments as needed throughout a year. Just as far as your payment terms and making those adjustments, and whether you're being paid quick enough, and whether you can incentivize anybody to pay quicker to help out with your cash flow, or whether you can make any adjustments in your payment terms to your vendors in order to pay later, to kind of tighten things up in order to help grow your business. A cash flow projection helps you to see the cash status of your business now and then plan for the future. So a cash flow projection, it's a good way to kind of prepare and plan for your financing needs. It's often required as a part of a business loan application as well. So if you're looking for lending in order to grow your business, they're often going to ask for a cash flow projection for 2 years in advance. A cash flow projection is a tool to help you manage your cash also, so you can pay your bills in a timely fashion and also make those adjustments like I mentioned. It's important to notice, or to note, what cash flow isn't, however, because it's the actual moving, like I said, kind of the lifeblood of the business. So when The balance sheet and the income statement are snapshots in time. Cash flow is actually the moving part of when cash is actually exchanging and moving at, in real time. So those are the documentaries. This is kind of when things are moving throughout the periods in between those snapshots. So for instance, there's a number of different factors and drivers in addition to profit that have an impact on a business's cash in any particular month. And this is why profit will never be the same as the change in the cash balance on a balance sheet, because having accounts receivable means that you're recording sales and profit before you actually get paid on a sale. And if you have inventory, this means that you're laying out cash and holding inventory before that you can actually sell it or get paid on it. Accounts payable means that when you record a vendor invoice ahead of time, you're not actually going to get paid on that for a later date. A capital expenditure is when you purchase a large item or vehicle, building, an improvement, and it's not going to be expensed at the same time until you get paid for it. So, of course, borrowing money, it's not income because you're borrowing money, so it's a liability. And paying a principal of a loan back, it's not an expense because you're just paying a loan back. So there's a number of other differences between the revenue and expenses that are being recorded on a P&L and when they actually impact a cash balance on the cash flow statement. So this is actually why 82% of business owners don't feel like they have the cash flow of their business under control. So as far as the cash flow statement, it's here to save the day with some sort of this showing the cash flow in and out of the business. Let's take a look at what the cash flow statement looks like. So this
Hey,
is the cash flow
Brian.
statement.
Hmm.
Yep.
Hey, you've got about 7 more slides,
Yep.
and it is 2 minutes till 11. So just giving you a heads up. And we have some questions that haven't been answered.
Okay. Yeah, we'll cover this one, and then we'll kind of briefly go over the next ones, and then we'll answer some questions. So it looks as if the 3 broad categories are the cash monitoring and the net change in the cash from operating, investing, and financing activities. It can help to determine the pulse of a business, so to speak, the cash flow statement. It can also be used as a tool to determine the short-term viability of a company, because if it's set tight on cash flow, it's kind of a red flag. Let's go ahead and the next slide. So the direct method of forecasting cash flow relies on the simple overall formula that cash flow equals the cash received and cash spent. This is the so the cash flow equals the cash received and cash spent. So actually, go back one to the cash flow statement one more time. Sorry, I didn't realize I wasn't quite done with that. So on the note of the cash flow, rather than just focusing just on that cash flow statement, if you're like me, this looks like a lot of numbers that can be overwhelming when you start on day-to-day management. I propose that business owners should be able to focus just on what's going on in their cash flow by having like a cash flow focus report that just really focuses on the 3 main factors from a month-to-month basis. And that way they can see what's really going on and focus just on like the 3 main drivers of their cash flow. So this would focus on attention just on those 3 main things and whether something is good or bad. So sometimes an increase in cash isn't necessarily good, and sometimes a decrease in cash isn't necessarily bad. So if you want to really look and feel like you have the cash flow of the business under control, and you kind of want to pass the partner test, do this. I would suggest that you writing a 1-line description for each of the 3 biggest changes in a cash flow, just by print out the general ledger of your business on a month-to-month basis or your bank statement and say, okay, what was the 3 biggest changes in cash flow from one month to the other, and highlight that, and then just say whether it was a good or bad and see if you can explain it. And all you need to do is be able to kind of explain what that change was, and then whether it was a good or bad change, and that'll help you kind of forecast for the future. you have the cash flow statement to kind of rely on, but that'll make sure that you at least have an understanding of what's going on in the cash flow statement. So a good cash flow forecast will help you to forecast far into the future, but on a month-to-month basis, it's good to have a understanding and show to a banker, an accountant, or a business partner that you really do understand what's going on from 1 month to the next by understanding what money has been spent from one month to the next by having a cash flow forecast or a focus report just on those 3 largest drivers. Okay, now we can look at the P&L statement. So the P&L statement, it's the best tool for knowing if a business is profitable. P&L statement, it measures the revenue. I mean, a lot of people are familiar with the P&L statement. Obviously, it's the in and out of the business. So it's the income or the revenue, the cost of goods sold, the cost of sales, like we mentioned. It gives you the gross profit and minus the overhead, and gives you the net profit. Most accounting software will actually give you a good P&L statement now in its reports. I don't know if we have the poll question. We can skip the poll question for right now. Let's move on to the next one. So business financing, the following items are the elements of business financing. Yeah, equity financing, debt financing, and working capital and fixed asset financing. So as far as equity financing, invested funds that stay in the business are often permanently. So for small businesses, this can come from an owner, family member helping to invest. For larger, fast-growing companies, this can be a venture capital. As far as debt financing, borrowed funds can be paid back. This can be like a loan from the bank. As far as working capital, money that's used to pay for the daily operations. And fixed asset financing is when you're purchasing vehicles and equipment. A little bit more on that on the next slide. What you need, these are some of the things that you need to in order to get some of that financing when you go into the bank. If you have some of these statements and you look well prepared when you go into the bank, obviously they'll tell you more of the documentation that you need and be prepared for. But really, if you have a lot of these things under control, and especially if you have the cash flow under control or understood, even with the cash flow focus report, it'll be a tremendous asset in order to answer the questions and be able to let them know what you're looking at doing for a loan. We can move on to the next one. So as far as what can be actually used as far as financing, so for most businesses, there's 3 key ways of finance operations. So you got small limit credit cards can be used solely for business purposes. So even if you use a personal credit card, you can always use that solely for business purposes, and that can be documented as long as you're not commingling funds with your personal with a personal credit card. As long as it's strictly used for business purposes, you can use that. So sometimes somebody will get a promotion for an 18-month either balance transfer card or a 12-month on purchase personal business credit card offer. You can use that credit card and solely use it for business purposes for your business for funding. As long as it's only used for the business, you can use it for that purpose, even if it does not say it's a business credit card. Home equity lines of credit. Home equity line of credit right now is around 7%. SBA loans are around 11 and 12%. So if you have equity in your home, it can be an underutilized asset in order to get some business funding. And actually, the credit card and the home equity line can be used in tandem. If you just need something for 60 days, say, and then you need a little bit more time, you can kind of use those together, and you can put something on the credit card, and get that grace period. And then rather than paying the credit card interest, you need a little bit more time, you can come in with a home equity line and pay that for a little extra time, so you're never paying the actual credit card interest. A trick to using these in business is how they can be used as a tool or a resource. So there's also business lines of credit, there's business term loans, and there's also business mortgages. The thing to keep in mind is you can think unconventionally as well, and like I said, look at, credit card offers can be used. Sometimes there's products like Melio, and there's Plastic, which will actually turn credit card payments or credit card purchases into check payments for people that don't take credit cards. So sometimes some of those, even the personal offers on credit cards can turn into something if you have one of those offers for the 12-month on purchases and things like that, or the 0% interest if you need smaller loans. The next one. This is just saying, know how to get your credit score, your repayment ability, and be responsible with credit. You can file it Dun and Bradstreet, dnb.org or dnb.com. File for free to start your business credit, so it's filed on there. And then some of your suppliers will report there to start building your business credit, which is separate than your personal credit, which you will want to start doing as early as possible. Start building that as being separate, but also you'll want to make sure that you are getting your personal reports as well through Credit Karma and some of those other services as well. I know Granger always reported to the DNB, so things like that. DNB and Experian are the two business credit filing services that report and also can help you get business credit kind of on file. Next one. So there is the SBA. SBA will fund acquisition loans now up to 90%. So a lot of times, if you're looking for growing a business through acquisition and it's an industry that you're already involved in, they can actually do a loan with no down payment as long as it's a local business or something that you're already going into. So that's always worth looking into. Again, those rates can be between 11 and 12%, but if you don't have to put a down payment down, a lot of time the SBA qualification is on the existing business rather than your personal business. So keep that in mind as well. So the qualification is on the existing business. So if you're looking to grow through acquisition, banks actually are the ones that underwrite the loans that go through the SBA. So you'll want to check with banks first, especially ones that specialize in SBA lending and regional lending organizations. So credit unions can also be great resources for those smaller dollar loans. And I think we're on to the last slide. So just a reminder, so financing is getting the money that you need to start, operate, and grow your business. Before borrowing money for a business, develop a business plan, determine whether the business can afford the loan. And if you need to borrow money, take the time to comparison shop for the best loan options. And also think, unconventionally. Budgeting is the start of financial management. And like I said, you want to make sure that you're looking at the whole picture, not just, numbers and line items and what they are, but also how they're going to impact your business as a whole through those 4 types of expenses that I mentioned before, which are the destructive, consumptive, protective, and productive. The start of financial management is your bookkeeping, and the basis you want to make sure you're documenting things. The better documentation, the more information that you can get from that documentation. Cash flow projections will help you see the cash flow shortages, and the accrual accounting may mask some of these shortages in the cash flow. So if you're on accrual accounting, you'll want to still look at like that cash flow focus report that I mentioned before, which is kind of that month to month. See how the cash changed from one month to the other. Highlight those 3 biggest changes and whether it's good or bad. And profit and loss statement is the best tool for knowing if your business is profitable. Just because you bring in a lot of money, if you spend a lot of money, it really doesn't matter. And I think that wraps us up for today. And I can answer any questions.
Okay, most of all the questions are actually in the chat, and most of them we covered, Brian.
Okay.
I think one of the questions we had towards the end was where did it go there? So there was a question about when you're doing your month to month. It's way down at the bottom. How do you easily do a rolling cash flow statement? mean, some of it would be filled with actual expenses, and then basically after that, it'd be a forecasted numbers, right? Brian?
Wait, there we go. Sorry.
Did you hear the
website
question?
away. Yes, I did. Yeah, so you can do a rolling forecast by projecting out. So
You're very, we can hardly hear you.
sorry. The mic's back. Good. So yes, a cash flow projection would take into account of what you plan to spend and any differences that you plan to make over the next 12 months. But as far as doing the cash flow forecast, you would look at what you previously spent in the month prior, and then what your current month is, and you'd highlight those differences in order to know what the next month is going to bring. So if you notice that this month you spent $3,000 in inventory that was previously there the previous month, you're going to know that you spent that $3,000 for something that may be coming in next month, because it's going to strike that reminder. And if not, you can kind of look into that, which is why a cash flow focus report and just seeing those three biggest drivers can kind of hone in on just those three largest things to kind of explain what's really happening in your business, without all the kind of small stuff going on as well.
Okay.
And that would be a month-to-month basis.
Okay. Let's see, what else was there? There's a question about where we can go to find the recording of this. You need to go to our website, which is score.org, and click on the menu, and you'll see workshops and events is one of the items. You click on that, and then to the recorded webinars. It's pretty simple. I'm not sure when this will get posted, but eventually it'll get there. So let's go back here to the questions. There was a question about started with this is from Christopher. Does a draw depend upon the legal structure, C Corp versus an LLC?
Yeah.
And then there's a question about a B Corp.
Okay. So you can always take a draw, but the rules in regard to how you're going to report that on taxes are going to be different for this structure of the business. For instance, a partnership, if it's filing an SS Corp or a C Corp, if it's a multi-member, has to be equal. So if one person wants to take a draw, then everybody takes the same amount. Now, a single member LLC, it can be any time. But that's more of the tax election than the corporate status.
Let's see. And there's a question about EBITDA, EBITDA.
Mm-hmm.
I'm not sure what that is. David was asking that.
Yep. So interest before taxes and appreciation, or amortization, sorry.
Okay.
Yep. So on the balance sheet, what that's going to show you is what a business would be if somebody wasn't paying the interest, the taxes, the depreciation, or the amortization. So the idea is that if somebody else was to come in to take care of that business from day one and did not have depreciation, amortization, taxes, or interest to pay, which would be their loans, that would be the true profitability of the business, which is why it's considered a factor of evaluating a business's true value. So you just back out those numbers or add them back on the balance sheet to give the profitability of the business. Because if somebody else was to come in and run that business, they would have a new set of depreciation, amortization, interest, and taxes.
Okay. I'm not seeing, if you have any other questions, well, let's see, there's one just popped up. Alyssa, no, we won't be sending it out. You'll have to go to score.org to retrieve it for the recording. When you go to
Ed,
score.org, hit
Ed,
the, yes.
we do send out a notification that the link is available.
Okay. All right, thank you. So are there any other questions before we pull the plug on this? Brian, I would look through the chat. There's a lot of very positive comments about it. I do want to apologize. We were not able to get the poll function working. So we apologize for that. And lastly, when you talk about financing your business, we do have a panel discussion coming up in April the 8th, where we'll have someone from the SBA, someone from a local banking organization, as well as someone from ECDI who does micro lending. So you should receive some kind of a notification via email that's coming up if you wish to register for that. Let's see. And from Felicia, yes, you will receive a copy of the PowerPoint shortly, sometime this week, I would think. So any other questions? Okay. Brian, looks like you overwhelmed everybody.
Yeah. Thank you. These I've had an echo in my ear the whole time. And it's been distracting with my ADD.
Yeah. Hey,
so thank you for everybody putting up with me.
Yeah. Hey, one other comment is to those of you that are still on, if you have questions and I mean, please contact SCORE to help. If you go to that score.org website, you can request a mentor from chapters that are close to you who can help you with a lot of what Brian discussed. So, okay.
All right.
I think that's it. Brian, thanks a lot.
All right,
thank you. Those of you that are still out there, thank you for joining us. And please reach out to us if we can help in any way. Thank you.
All right. Thank you.